In the autumn of 1923, a respected physician in Berlin made a decision that would haunt his descendants for a century. He was not a gambler. He was a prudent man, a saver, a believer in the rules of the old world. For 30 years, he had worked 12-hour days, treating patients, saving every spare mark, and investing carefully in the safest asset known to his generation: German government bonds. He had built a substantial nest egg, enough to guarantee a comfortable retirement for himself and an inheritance for his children. That October, he decided to sell his beautiful 3-story townhouse in the heart of the city. He wanted to move to the countryside, to a quiet estate where he could live out his days in peace. He sold the townhouse for a massive sum of paper marks. It was a number so large, with so many zeros, that he briefly felt like the richest man in Europe. He deposited the cash into his bank account and took a few weeks to organize his affairs and say goodbye to friends. But while he was packing his bags, something terrifying was happening in the streets outside. The printing presses of the Reichsbank were running 24 hours a day, engaging in a desperate attempt to pay off war debts with worthless paper. Prices weren't just rising. They were doubling every few days, then every few hours. By the time the doctor went back to the bank to withdraw his fortune to buy his country estate, the teller handed him the cash in bundles that were stacked to the ceiling. But when he arrived at the countryside estate, the price had changed. Hadn't just gone up, it had gone up by a factor of 10 billion. He looked at the money in his hands. 30 years of labor. The price of his family legacy. It was now only enough to buy a single ticket to the theater. He walked out of the bank, dazed, bought the ticket, watched the play, and came home to nothing. Zero. His legacy, his security, his past, and his future were erased in less than a month. This is not just a tragic story about history. It is a warning about a mathematical law that has governed every financial collapse in the last 500 years. I call it the rule of zero. And right now, whether you realize it or not, millions of Americans are standing on the exact same trapdoor that the German doctor stood on in 1923. They just don't know it yet because the floor hasn't dropped. Most people think an economic collapse means prices go down. They are hoarding cash, waiting for a crash so they can buy cheap houses and cheap stocks. But that is the mistake that wipes out the middle class. In a true currency crisis, the price of assets does not go down. It goes up. It goes up to infinity against the currency. But the value of the money in your pocket goes to zero. With $38 trillion in national debt, spiraling interest payments that now exceed our defense budget, and major institutions quietly moving their capital to safety, the stage is set. History is not just repeating itself. It is screaming. But for a select few those who understand the mechanics of what is coming, this will not be a tragedy. It will be the greatest opportunity of their lives, because wealth is never destroyed. It is merely transferred, from the uninformed to the informed, from the holders of paper to the holders of things. In this video, I'm going to hand you the survival map. I will show you the 3 assets that historically go to zero during a collapse, and the 3 assets that have survived every single time, from Rome to Weimar to Zimbabwe to Venezuela. This is not financial theory. This is a survival briefing for the year 2025. The trap and the money illusion to survive what is coming. You first need to understand the weapon being used against you. It is a psychological weapon called the money illusion. It is the reason why the stock market in Venezuela hit record highs while people were eating out of garbage cans. It is the reason why the Dow Jones might hit 50,000 or 100,000 in the next few years, and you will still feel poorer than you do today. The money illusion tricks you into focusing on the nominal price of things rather than their real value. It makes you feel rich when you are actually dying financially. Let me break down the 3 specific traps that rely on this illusion. These are the assets you must sell, reduce, or hedge immediately if you want to preserve your purchasing power. Trap number 1. Cash and savings, This is the hardest one for conservative investors to accept. We are taught from a young age that cash is safe, cash is king. But in a sovereign debt crisis, cash is trash. Imagine you have $100,000 in a high-yield savings account paying you 4% interest. You look at your statement at the end of the year and you see $104,000. You feel responsible. You feel like you are getting ahead. But you go to the grocery store and beef is up 20%. You pay your car insurance premium and it is up 30%. You look at property taxes, utility bills, healthcare costs. The real rate of inflation for the things you actually need to live is closer to 10 or 12%. So, let's do the real math. You gained 4% in interest, but you lost 12% in purchasing power. Your real return is negative 8%. You are bleeding wealth, but because the number in your account went up, you don't feel the wound. That is the illusion. In every major inflation event in history, the people who held cash were the first casualties. They were the boiling frogs. Cash is not an asset. It is a liability of the bank, and it is a melting ice cube in your hand. Trap number 2. Long-term government bonds. This is the widowmaker of the 2020s. For 40 years. From 1980 to 2020, owning US Treasury bonds was a brilliant trade. Interest rates fell consistently, and bond prices rose. It became the foundation of every retirement portfolio, every pension fund, every standard 60/40th split. But the 40-year bull market in bonds is mathematically over. We are now in a secular bear market for debt. Here is the mechanics of why this is a trap. It is called duration risk. When you buy a 30-year Treasury bond paying 4%, you are locking in that rate for 3 decades. But if inflation spikes to 10%, nobody wants your 4% bond. Why would they buy your bond paying 4% when inflation is 10%? They wouldn't. To sell it, you have to lower the price massively. If rates rise just 2 or 3%, the face value of long-term bonds can crash by 30, 40, or 50%. We saw a preview of this with Silicon Valley Bank. They didn't buy crypto. They didn't gamble on penny stocks. They bought safe US government bonds. And when they had to sell them to raise cash, they realized those bonds had lost billions in market value. They were insolvent within hours. Wall Street insiders now call long-term bonds certificates of confiscation. They promise to return your principal in 30 years, but by the time you get it back, that money will buy a cup of coffee. Do not be the bag holder for the government's unpayable debt. Trap number 3. Speculative growth stocks. I am talking about the zombie companies. The companies that make no profit. The companies that pay no dividends. The companies that have survived for the last 15 years solely because interest rates were near zero. They borrowed cheap money to buy back their own stock, artificially inflating the price. But the era of free money is gone. As interest rates stay higher for longer to fight inflation, these companies face a wall of debt maturity. They cannot refinance at 2% anymore. They have to refinance at 8 or 10%. But their business models don't work at 10% interest. When BlackRock and the smart money start underweighting US equities, they are quietly selling these zombies to retail investors. They are rotating out. When the liquidity tide goes out, these companies will go to zero. Just like the dot-com bust, but worse, because this time the currency itself is the problem. So, if cash is melting, bonds are crashing, and tech stocks are zombies, where do you hide? How do you survive when the system resets? The Ark. The 3 survivors. History gives us a clear answer. There is a specific class of assets that acts as an ark during the flood. These are assets that have no counterparty risk. This is the most important concept you will learn today. Counterparty risk means your wealth depends on someone else keeping a promise. A stock depends on the CEO. A bond depends on the government. A bank deposit depends on the bank's solvency. But real assets? They depend on nothing but the laws of physics and supply and demand. Here is the holy trinity of survival assets. Survivor number 1. Gold and silver. I need you to completely reframe how you think about gold. Stop checking the price of gold in dollars every day. Stop thinking of it as a way to make a profit. Gold is not an investment. Gold is money. Everything else is credit. In 1923 Weimar Germany, an ounce of gold could purchase an entire city block of commercial real estate. Why? Not because gold became magical, but because the paper currency collapsed so completely that anyone holding real money became a king. Central banks know this. Look at what they are doing, not what they are saying. China has been buying gold for 18 consecutive months. Poland is aggressively increasing its gold reserves. Singapore is buying. Turkey is buying. Even US states are passing laws to recognize gold as legal tender. They are preparing for a monetary reset. And specifically, you need to understand Basel III. This is a global banking regulation that recently reclassified physical gold as a Tier 1 asset. That means for banks, gold is now considered as risk-free as cash. This is a massive signal that gold is returning to the center of the financial system. But a warning, you must own the physical metal. Do not buy GLD or SLV or other paper ETFs. In a crisis, those funds have clauses that allow them to settle in cash, not metal. If the system breaks, you don't want a check. You want the metal. And don't forget silver. Silver is the only asset that is both a monetary metal and a strategic industrial commodity. It is needed for solar panels, EV batteries, missiles, and electronics. The world is currently in a structural deficit of silver. We use more than we mine. When the monetary demand meets the industrial shortage, the price of silver will not just rise. It will explode. Survivor number 2. Productive land. Notice, I did not say real estate. I said productive land. There is a massive, critical difference that most investors miss. In a hyperinflationary depression, buying a generic suburban house to rent out can be a disaster. Here is why. When inflation destroys the middle class, people cannot afford to pay rent. Homelessness spikes. Governments, desperate to stay in power, will pass rent control laws. They will make it illegal for you to raise rents to match inflation. They will make it illegal for you to evict tenants who cannot pay. We saw this in Europe in the 1920s. We saw it in New York. We are seeing it now in Spain and parts of Canada. You end up with a property that costs a fortune to maintain, taxes that keep rising, but zero income. That is not an asset. That is a liability that eats you alive. Productive land is different. I am talking about farmland, timberland, land with water rights. Why is Bill Gates the largest owner of private farmland in America? Why are the ultra-wealthy buying ranches in Montana and New Zealand? Because productive land produces essential goods, food, lumber, water. No matter what happens to the dollar, people need to eat. A government can freeze your rent, but they cannot stop the corn from growing. They cannot stop the trees from maturing. In Germany, after the 1923 collapse, the Junkers, the landowning class, were the only ones who retained their wealth. They traded potatoes and wheat for gold and diamonds, while the city bankers starved with their wheelbarrows of paper money. If you can't buy a farm, look for REITs that specifically own farmland or timber, but verify they have low debt. Look for companies that own the land, not just manage it. Survivor number 3. Essential commodities and energy. This is the lifeblood of civilization. Oil, natural, gas, copper, uranium, fertilizer. For the last 10 years, the world has starved the energy sector of capital. ESG mandates and political pressure forced companies to stop drilling and stop exploring. We have created a structural shortage of the very things that make modern life possible. This is the Cantillon effect in action. When the government prints trillions of dollars, that money eventually flows into hard assets. It bids up the price of the things we actually need to survive. During the stagflation of the 1970s, the S&P 500 went nowhere for a decade. If you held tech stocks, the Nifty 50 of that era, you got crushed. But if you held oil stocks, if you held commodities, you made a fortune. Energy is the master resource. You cannot have a lie without electricity. You cannot have crypto without electricity. You cannot have electric cars without copper and lithium. The assets that underpin the physical world are currently cheap relative to the assets of the digital world. That ratio is about to flip. If you want to own shares in the companies that have reserves in the ground, you want to own the producers, not the consumers. The signal and the 2025 pivot. Now, let's bring this back to the immediate danger. 2025. And the news about BlackRock and the institutional exodus. You might have heard rumors that BlackRock is moving over $2 trillion out of America. Let's be precise about what that means so you don't sound like a conspiracy theorist at the dinner table. They aren't just wiring cash to a Swiss bank account. It is more subtle and more dangerous. They are executing a strategy called underweighting duration. For the first time in generations, major asset managers are declaring US Treasuries as a risk to be managed, not a safe haven to be held. This is the signal. This is the silent exodus. They are rotating out of the dollar-based debt system and into real assets and emerging markets. Think about the hypocrisy for a second. On television, the financial pundits tell you to buy the dip. They tell you the economy is strong. They tell you inflation is transitory or under control. But in their private boardrooms, they are doing the exact opposite. They are buying infrastructure. They are buying single-family homes by the thousands. They are buying energy grids. They are buying the physical world while selling you the digital one. Why? Because they know the debt mathematics. They know that $38 trillion in debt is mathematically unpayable. There are only two ways out for the United States. Option A, default. Tell the world we won't pay. This would destroy the global financial system instantly. Option B, financial repression and inflation. Print the money to pay the debt, but pay it back in worthless dollars. History tells us politicians always choose option B. It is the path of least resistance. It is the hidden tax that no one votes for, but everyone pays. We are entering a period of financial repression. This is a technical term you need to know. It means the government will manipulate interest rates to keep them below the rate of inflation. They need negative real rates to burn away their debt. And the fuel for that fire is your purchasing power. If you stay in the trap, cash and bonds, you are the fuel. If you move to the ARC gold land, energy, you are the survivor. Common objections, the traps in your mind. Now, I know what some of you are thinking. I hear these objections every day. And they are dangerous because they sound logical, but they are wrong. Won't they print money to save the stock market? Yes, they absolutely will. But you need to understand that is not a solution. That is the accelerant. If the Fed pivots and prints trillions more to save the banks or the government, that is exactly what sends us into the hyperinflationary phase. So if they print, nominal stock prices might go up. The price of gas will triple. You cannot print your way to prosperity. Objection number 2. Deflation is coming first, then inflation. This is a valid point. We might see a short, sharp deflationary crash where everything sells off. We saw it in March 2020. But what happened next? The government panicked and printed $6 trillion. In an election cycle, With social unrest rising, no government will allow a deflationary depression to last. They will print. They will hand out stimulus checks. They will bail out pensions. Betting on deflation is betting that politicians will suddenly become fiscally responsible. That is a bet I am not willing to take. Objection number 3. But the US dollar is the reserve currency. It has nowhere else to go. This was true 10 years ago. It is not true today. Look at the BRICS nations. Look at Project Enbridge. Look at the Saudis accepting yuan for oil. The world is actively building a lifeboat that doesn't include the US dollar. It won't happen overnight, but it is happening. Hemingway wrote about bankruptcy happening gradually, then suddenly. We are in the gradually phase. The suddenly phase is coming. I want to be clear. I am not here to fearmonger. Panic is a luxury you cannot afford. I am here to empower you. The window of opportunity is closing, but it is not shut yet. We are not talking about something that might happen in 10 years. The yield curve is screaming. The debt clock is accelerating. The smart money has already started moving. You still have time, but not much. Look at your portfolio today. Tonight, ask yourself the hard questions. How much of my wealth is in things that can be printed by a central bank? How much is in things that rely on a counterparty? If the internet went down tomorrow or the banks declared a holiday, what would you actually own? If the answer scares you, good. Let that fear drive you to action. Sell the paper promises. Buy the physical reality. Become your own central bank. But there is one more piece to this puzzle. Knowing what to buy is only step 1. Knowing how to keep it is step 2. Because when things get truly bad, governments get desperate. In 1933, President Roosevelt signed Executive Order 6102, making it illegal for U.S. citizens to own gold. He confiscated it to bail out the government. He forced citizens to turn in their gold for paper money, and then he devalued the paper money immediately after. If you follow my advice and buy gold, but you put it in a bank safety deposit box, you might be walking right into a trap. You need to know how to store your wealth outside the system, legally and safely. You need to know about jurisdiction diversification. You need to know how to make your wealth invisible to the prying eyes of a desperate bureaucracy. In my next video, I'm going to break down exactly how to legally hide your wealth before capital controls begin. I will show you the storage solutions that the ultra-wealthy use. I will show you why your home safe might not be safe enough. So make sure you are subscribed. Click the notification bell. Do not let the algorithm hide this information from you. The system is pivoting. Make sure you pivot with it. I'll see you in the next briefing.